the Fed still matters a lot because they are the most powerful institution in the world. And it matters because monetary policy relatively tight has kept the ISM below 50 for 31 months. And so corporate America has operated with a bit of caution, keeping the car in low gear because they didn't know where inflation was going to be and they didn't know where monetary policy was. So I think when the Fed begins to ease, it's not just a move in interest rates, but it's a green light for corporations to get more confident. And as you know, the ISM moving above 50 does not only revive economic activity, it probably also rejuvenates the labor market, which has been sluggish for what looks like more than 12 months.
So does that mean if the Fed stays dovish or keeps cutting, that there's other newer legs to this pretty remarkable stock rally?
Yes, and I might even say that I think that we could have growth recover without inflationary pressures. I think reflexively, people the last few years think growth picking up means there's automatic inflation. That has not been the case for 25 years. But I think if companies begin to expand, plus the fact that we know AI is driving productivity gains, and that's really a big tailwind for businesses, and then we know that there's initiatives around Wall Street boosting productivity because they're going to build on the blockchain, I think there's a path for growth to be stronger next year without a pickup in inflation. That's going to be very good for profits and for equities.
One of the big misconceptions Lee pushes back against is the assumption that stronger growth automatically means higher inflation. That reflexive link may have felt true over the past few years, but Lee reminds us that for much of the past 25 years, growth and inflation haven't moved hand in hand. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
A pullback is going to be inevitable, but from a timing perspective, sentiment still remains staunchly negative. So, I think that the gold standard is the AAII, net bulls, less bears. That's been 6 consecutive weeks where it's negative. That's never really marked a market top. I mean, that has to flip positive and sustain for several weeks. So I think if we're going to say between now and year end, could the market pull back? I'd say it's possible, but to me, it's probably from higher levels. I think there was a lot of skepticism about even yesterday's FOMC. I had a lot of clients tell us they thought the stock market would sell off because 25 was priced in. But because almost everyone told me that, that was the consensus view. I think people were cautious into yesterday. And that's why we're seeing the groups that should rally big, like the small caps and the cryptos and the financials and even the Mag 7.
Another key insight from Lee: market sentiment is still stubbornly negative. For 6 consecutive weeks, the AI net bulls minus bears metric has been in negative territory. Historically, markets don't peak when investors are pessimistic. Instead, market tops form only when optimism is widespread, sustained, and often excessive.
I think for next week, the most important catalyst will be tech earnings. Micron, most critically Tuesday night, and then also Jabil and Accenture are also going to be, I think, important. The Fed and economic data gets a lot of attention, but really this market has been all about this amazing, breathtaking melt-up move that we've seen in tech, driven in large part by AI. So next week, we're going to 2 companies that are very levered to AI that benefit a lot from the enthusiasm and momentum, Micron and Jabil, and then a company that is thought to be potentially at existential risk from AI adoption, which is Accenture. So you're going to get kind of an interesting perspective from both ends of the spectrum.
Yeah, and I realize you just said that maybe it's not as meaningful to this market here, but we do get a flurry of Fed speakers next week too, and we do get that inflation reading. Is that really already baked in here, or could that have the potential to move markets as well?
I think it could definitely be interesting. There definitely is not unanimity on the Fed right now. You could see that from the distribution of the dots on the Wednesday supplemental. So, to the extent we hear a lot of the individuals explain how they are thinking on the outlook, that could be interesting. The PCE also obviously is the Fed's preferred inflation reading. So that's going to be critical as well. I just think for the most part, we have a decent sense how the data for the month of August shaped up. And so now the real, the focus, I think, is more on the September readings, which we'll get in a couple of weeks. But definitely the Fed obviously is front and center. So any speaker will be important to listen to.
Even as markets cheer the Fed's dovish tilt, Crisafulli highlights an important detail. The central bank itself isn't unified. The distribution of dot plots from the latest meeting shows real disagreement among policymakers about the pace and extent of future cuts. That means Fed speeches in the coming weeks will matter. Investors will be parsing every word for signals of consensus, or lack thereof. And with the Fed's preferred inflation gauge, the PCE, coming up, markets will get another test of whether inflation is truly contained or not.
The market seems to have moved on from trade. I think companies have a decent amount of clarity as to kind of how tariff policy is shaping up, and they're adjusting accordingly. I think very interesting will be later in the year when we start to get the Supreme Court oral hearings in the IEEPA tariff case. That's going to be in early November, so that's going to be really important. And there doesn't necessarily seem to be a consensus as to whether or not eliminating the IEEPA tariffs is good or bad. I think you can make an argument that striking them down at this point in time could be negative for the market. You could place upward pressure on yield given how much revenue they're generating. And also it's just going to create months of uncertainty if those were to go away. And the White House has to find new justifications to keep in place the tariffs, which they've said they're going to do. So I think for now, companies are kind of looking more at that IEEPA case in the Supreme Court. That's kind of the next real big tariff catalyst.
And Adam, Oracle has had this amazing move over the last several sessions. I mean, really, it was just one session. It was a major move, but it's held up. And here in overtime, it's higher by about 1% still. And again, it was up 4%, I believe, today. A lot of people might have doubted it can maintain anything near those levels after it reported its guidance. What do you make of the broader message in this move from a company that's been around for a long time?
You continue to see every day flurries of headlines talking about the unbelievable momentum that's occurring in AI. So today alone in the morning, there was an article on the information about OpenAI spending about $450 billion over the next 5 years on compute. Remember, that was the huge part of the RPO boost at Oracle. A lot of that was driven by OpenAI. So that's another positive, suggesting that the biggest, most prominent player in the industry continues to spend a lot of money. XAI, there was a lot of articles about them raising money at a $200 billion valuation. And then right before the close, there was a report on Bloomberg about how Oracle could be striking a deal with Meta for a $20 billion AI compute contract. So the headline and news flow around AI just remains extremely bullish. And Oracle really has risen to the top to become one of the most prominent names in the industry. And that continues to drive the shares higher.
Adam, I'm going to ask you the same question I asked Rebecca Patterson earlier in the hour, and that is, how are you gauging geopolitical risk, given some of the activities we're seeing play out across the world right now, even as we do see stocks at record highs, and given the fact that we are going into sort of the big, hefty week of UN General Assembly, too?
Yeah, it's definitely kind of fallen down the list, I think, of things that markets are focused on right now. And perhaps that creates a risk in that there isn't a lot of focus. What's happening in the Middle East doesn't really seem to be impacting the narrative. There doesn't seem to be enormous risk around oil supply, which usually is a transmission mechanism where Middle Eastern events will impact equity sentiment. And there doesn't necessarily seem to be a lot of kind of focus for U.S. stocks about what's happening in Ukraine right now. There has been rumblings in Washington and Brussels about imposing incremental sanctions on Russia and potentially buyers of Russian energy, but it doesn't seem like there's a ton of momentum for imminent action on that front.
So, what's the big takeaway from Tom Lee and Adam Crisafulli's discussion? The Fed still sets the tone, but the next phase of this rally may be defined less by policy moves and more by corporate confidence, AI-driven productivity, and earnings growth. Inflation may not be the enemy it once was, provided productivity gains keep pace. Sentiment remains negative, which ironically is bullish. And while tariffs, Fed divisions, and geopolitics could all spark volatility, the broader backdrop points to continued strength in equities.